Hello everyone, my name's Kyle, and today we're going to be talking about the evolution of Islamic finance in the modern world. So modern Islamic finance didn't really start until the 1970s, and we're going to be looking at it in three different groups. The first one being 1975 through 1991, the second stage being the decade of 1991 through 2001, and then the third is going to be in the post 9/11 era. Granted, there were a precursor to modern Islamic finance in India, which is actually modern day Pakistan. However, this was before partition, so technically it's still India, but this is when uh, Britain had control over India. And what happened was Islamic scholars started addressing the feasibility of banning riba and being compliant with Sharia law. Now, most of these debates were pretty much just theoretical until the rise of pan-Islam and the boom in oil prices, which was from 1973 through 1974, where the price of oil roughly quadrupled. So in 1975, King Faisal of Saudi Arabia wanted to form a pan-Islamic bank based on the assumptions that idle funds that weren't in the contemporary banks would flock to Islamic banking because they wanted to have a moral backbone to their banking sector. So they created the Intergovernmental Islamic Development Bank to manage to manage income from interest in non-Muslim countries, zakat funds, which are the compulsory giving or donating to charity, finance reciprocal trade, and serve as a clearinghouse between Muslim countries. The Islamic Development Bank was founded by 44 member countries, with the primary shareholders being Saudi Arabia and Libya, having a 25% and 16% stake respectively. In 1983, Turkey created special finance houses, which were really just Islamic banks under a different name. So these houses only had to keep a 1% reserve requirement in the central bank, while conventional banks were required to have a 10 to 15% reserve requirement. And in 1984, Turkey banned banks from running ads on television. However, these special finance houses were given permission to continue running ads. At the same time, in Egypt, they had created Islamic money management companies. So instead of having savings accounts, they claimed to manage public funds and paid investors with dividends under mushakra, which are partnerships in Islamic culture. So technically, they were not giving out interest. However, as a recurring theme through this series, Islamic finance does manage to keep the word of Sharia, but typically violates the spirit that was put forth in it. So because a lot of these banks didn't have reserve requirements in Egypt, they didn't also have to create banking disclosure agreements. So after a while, banks started getting upset, and they ran propaganda against the Islamic money management companies, saying that they were using religion as a mask to make money and were acting hypocritically. The Islamic money management companies, or IMMCs, quickly responded by saying that the banks were just jealous of their success. So in 1988, many of the IMMCs had financial problems with liquidity because they didn't have reserve requirements. So the government had to step in and set a 10% reserve requirement and force them to publish audited financial statements. However, by this point, most owners of the banks had fled the country and the banks were insolvent. This brings us to our second stage in modern Islamic finance, which will be the decade from 1991 to 2001. So during the 90s, a number of secular banks started opening windows where people could go in and either have standard accounts set up or they could have Islamic compliant products. Today, in 2019, virtually every conventional bank in the Middle East or Islamic world offers some sort of Islamic investment options. This will move us to the third stage, which was the post 9/11 stage. So right after the attacks on the World Tower in 2001, there was a short-lived period of withdrawal from the accounts because people didn't want to be financing institutions that also paid for terrorism. However, the Arab and Malaysian models quickly converged to standardize Islamic banking practices, and people were once again interested in following Sharia-compliant banking. Now, the 2008 financial crisis is a particularly interesting thing to look at because this crisis was caused by derivatives upon derivatives in the housing market, and Islam specifically does not allow this practice because it's outlawed in the Sharia, because subprime loans, which are the derivatives on derivatives, are a sale of debt. And credit default swaps, which are a sale of promissory notes, are considered gharar, which we had talked about in the last video, which is uncertainty. Now, Islamic banks were still affected by the 2008 financial crisis, as was the rest of the world, because Islamic banks were primarily asset-backed, but they managed to withstand the downfall and effect of the crisis better than conventional banks. Thank you for watching.